Welcome to the Stock Workout, where we flex on the market to make gains. In this video, we're going to be speaking about IQST. I'll be running through a bit of news that's come out, and then we're going to take a look at the charts. I will also be speaking about the broader market and how the NASDAQ and the 10-year bond yield has affected a lot of stocks and has affected the rest of the market. I'll be speaking about how the 10-year bond yield rising slightly has caused a sort of mass panic and sell-off in the wider market. Then we'll go on to speak about the news on IQST that's come out to do with the EV batteries, and then we will be taking a look at the charts and seeing where we stand. But before I get into any of it, if you haven't already, subscribe so I can keep bringing you more content, like the video and support the channel. So now if we take a look at the NASDAQ composite index and we speak about the broader market, we can see that we ended the week at 13,215 points. At the beginning of the week, we opened around 13,330 points. So we were down about 95 points. We saw the NASDAQ pick up twice in the week. This was Wednesday over here, Wednesday 17th of March, and we were waiting for the Fed to give their presentation to let us know what is expected from the US economy and what the growth is going to be. They gave us all the numbers then and we saw it pick up. However, we did see it sell off once again. This sell-off would have been attributed to the 10-year bond yields. It came down quite low, down to about here, 13,035 points, and then we did pick up by 99 points again, which is a good indication. We were up 0.76% on the NASDAQ when we ended on Friday. That was just for the day. Overall on the week we were down slightly. If I just draw a quick info line, we could see that when we opened on Monday up until closing on Friday, we were down about 115 points. So we were down 115 points for the week. So that was that. But when we were on the lows on Friday, we were down around 290 points. So we did recover slightly, which is a good indication. This sell-off has been attributed to the 10-year bond yields, and I'll get onto that in a second. If we take a look at the last 6 months of the NASDAQ, this is the general trend and the general overall picture that you can see. So previously there have been dips. Now these would have been when there's a sell-off in the market like there is here. So if you take a look from the peak there to the low point there, it was down around 1,100 points. Came down about 9.4%. Now any sell-off of 10% is considered a correction. Anything over 20% is considered a bear market. So when we take a look at this sell-off that's happened more recently, you can see that from this peak here to this low here, we were down about 12.5%. So at that point, we were in a correction territory. That was down here. And then when we move up to here, if I just swing that across, when we closed on Friday, since the high, since the previous high, we're down about 6.5%. So we're not currently in correction territory anymore, but a lot of stocks have been hit hard. Now this has been linked with the 10-year bond yield. So if I flip over to the 10-year bond yield, you can see this is it. So in the last week, if I pull up the 5-day chart, so when we opened, we were around here 1.63%. When we closed on Friday, we were up to 1.71%. On Friday it did come down slightly by 0.18%, but for the week we are overall quite up. It did shoot up quite quickly, and that is reflective in this sell-off that's been going on in this last week. If I switch back to the 5-day chart, as the bond yields came down, we saw the NASDAQ pick back up, and as the bond yields picked up and increased, we saw the NASDAQ sell off and literally crater. A lot of stocks did crater. Penny stocks are always hit harder than your big caps. So as I've drawn this trend line here, overall the NASDAQ was down by about 0.8% for the week. So that is the fourth negative week the NASDAQ has had overall out of the past 5 weeks. So you know, it's a bit of a mixed bag, but overall I do believe we are on the up, because if you switch now to the 3-monthly chart, you can see that we're quite up from the previous lows, and hopefully we are going to carry on. Oh, let's just close that. We are going to carry on picking up. Now, for those of you who don't know, the Fed said that it upgraded its 2021 GDP growth forecast to 6.5%, and that's the largest increase that we've seen estimated since 1984. It also said it expects unemployment to drop, which is a good thing, and that is bullish for stocks. Now, from the Fed's presentation, they have indicated that and said that with their policies, you know, they've created a perfect opportunity for companies to and the economy to continue growing, and that is the bullish stance for it. Now, the bearish stance for stocks specifically is basically to do with the 10-year bond yields. However, I do think this is slightly overstretched and a little bit unfair that tech stocks have been hit so hard. We've seen a rotation of money. We've seen hedge funds moving the money out of tech stocks into sort of banking stocks, which is why you did see the S&P hit new records and hit new highs on consecutive days. Now, one of the bearish scenarios for stocks is that if the 10-year bond yield does carry on climbing, and if it hits 2.5%, if it goes up and carries on climbing and sort of hits that 2.5% mark, bonds may start becoming more attractive instead of stocks from a returns perspective. Now, those are not my own words. Those were from a manager survey from the Bank of America. This is what they said, that at 2.5%, bonds may start becoming more attractive instead of stocks, because you've got to realize as well, a lot of the bonds are purchased from other countries, other banks, other institutions in outside of the US, and from foreigners. A lot of the Japanese people do buy government bonds, US government bonds, because the US government bonds are better than their own Japanese government bonds. So the higher the rate, the more attractive it is to people, and that's when you'll see people with deep pockets moving money out of stocks into the government bonds. Also, on the flip side, if there's not enough demand for the government bonds, you will see that the yield will increase to attract new buyers. However, when we did see the last auction for the government bonds, they went through without a hitch. So I think that this is just an overreaction to bond yields rising, and this is the reason why. If we go back, if we go back sort of on the 5-yearly chart, as you can see here, the yields were sort of around 3%. And at 3% back in November 18, you know, markets were still doing good. Stocks were still doing good. Recently, we have seen the yields increase, and they've been increasing quite rapidly as well. However, I don't think it constitutes to there being a need to have a huge sell-off on the stocks. I don't think that the NASDAQ needed to be hit as hard as it has been. However, that's the case. This is now the yearly chart that I've got the NASDAQ Composite Index up, and you do sort of see it come down. I haven't measured this yet, so I don't know if this is a full-on correction, but it may be. It fluctuates. This one, so the NASDAQ did come down to its 100-day moving average. It's bounced back up to its 50. It's close to its 50-day moving average now. So this provided a good buying opportunity for anyone that wants to hold stocks long term. Now, just to Now, just to finish off talking about the NASDAQ composite and the 10-year bond yields, you can do a side-by-side comparison. I've got the 5-day chart up. This is the 5-day chart of the NASDAQ, and this is the 5-day chart of the 10-year bond yield. As you can see, later on in the second half of the week, as you do see, the 10-year bond yield does start to increase. When you flip back over to the NASDAQ composite, you see the NASDAQ composite start to drop. So there's inversely related, and NASDAQ has been hit quite hard due to these bond yields. However, I do think it's an overreaction. The economy is set to grow 6.5%, which is amazing given the conditions with the whole pandemic. So this is also something to take into consideration with your stocks. If you are in the minus, you just take this into consideration. So that's all the information on the broader market. Now, if we take a look at the news that has come out. So IQST released a tweet on their Twitter. They are really active on Twitter, so following them is a good idea. So they've said their partner Modus releases their first ever Retrovolt electric motorcycle demo video, and IQST is looking forward to provide all of the IoT Smart EV and IQ batteries EV for their motorcycles. So I've got this link open right here, and you can see that's a picture of their motorcycle. Now, I'll leave the link to this article in the description down below, so you can check this out and watch the video yourselves. But if I just zoom in onto one thing here, it says over here, Modus today highlighting a new design feature that will be included in the first 200 Retro Revolt electric motorcycles coming to market in North America this year. Now, one thing to note is that they're releasing 200 motorcycles, but they've also already received pre-orders for the first 200 as well. So that's good. They have confirmed sales. So I'll leave the link to this article in the description below, and you guys can check out the motorcycle. I think it looks pretty cool in my opinion. For an electric bike too, it does look pretty cool. So now, taking a look back at the charts. In my previous video, I drew a fib retracement and I let you know of different price points. One of the price points was the 61% Fibonacci retracement, and that sat at $1.03. Now, as I've already mentioned, with the whole market sell-off, a lot of stocks have been hit hard. Penny stocks usually get hit harder than most other stocks. But I do think IQST has held up pretty well in the last week or so, with the broader market sell-off, you know, taking place. Everybody overreacting to the 10-year bond yields. But I've already spoken about that. So $1.03 was the 61% Fibonacci retracement, and we did dip slightly under that and bounced right back up. It was a little bit volatile, and we closed on Friday at $1.07, and in the after hours dropped to $1.06. So we have held that 61% Fibonacci retracement. Now, we seem to have bounced off that a few times now, so hopefully that will continue to hold. So still, one of the price points to keep an eye on is that $1.03. That is the first line of support. I've drawn that on the chart there. That's the first line of support, $1.03. One thing that you do need to take note of is the fact that the 21 EMA has dipped below the 50, 100 and 200 day moving average. Now, this is not something that we want to see. However, that was the case. Also bear in mind that with the market sell-off, RSI has been quite low, and it started to pick up in the afternoon on Friday. Now, what was this due to? This was due to the news that got released. So as soon as IQST released their news, the stock started picking up once again. This is how important a catalyst can act with a small cap company. And as we know, IQST are doing great things, and you know, they've got multiple moving wheels because they're moving ahead with all different aspects of their business. They're not concentrating on one and leaving four to the side. They're moving everything together, which is brilliant. That's what we want to see as investors. So, you know, volume did pick up slightly in Friday afternoon. RSI did pick up, people started picking up the stock, so it did bounce from around this dollar mark back up to $1.07. It closed at, so it was up for the day 4.39% on Friday. Now obviously this is not a good signal to see that the 21 EMA has crossed under the 50, 100 and 200 day moving averages, but we are starting to see that 21 day EMA starting to curl upwards once again. Now I've drawn a fib retracement once again, just to give you the range that we are trading in at the minute. So your 61% Fibonacci retracement was at the $1.03 point. The retracement above, which is the 50% retracement, is at $1.10. So we are trading in quite a tight range. We're sat right in the middle of that range. If we continue seeing ourselves bounce around that range, then that would be good. Obviously here twice when the RSI did drop quite low with the sell-off, we dipped below the 61%. We didn't reach the 78%, but we did bounce back up. We closed in the middle of the 50 and 61% Fibonacci retracement. So your next line of resistance would be that $1.10 mark, and after that it would be the $1.17. However, with the 21 day EMA trading below the 50, 100 and 200 day moving averages, I would sort of take these price points quite lightly, because we do need to see that 21 day EMA pick up back over the simple moving averages, and at which point I believe if we do, we would see higher prices than these 2 points here. So me personally, in my opinion, I wouldn't be looking to take profits at the minute at either one of these 2 points, because I do believe this stock has much more room to run up higher. The only main thing to take into consideration is the fact that we are closed and have remained above the 61% Fibonacci retracement. First line of support is that $1.03. The next one after that is at 92 cents. Now a lot of it does depend on the rest of the market that I've already spoken about. If it continues to sell off, we might see a retracement come down further to that 92, 93 cent mark. If not, if we hold up, then that's great things to see. Do keep an eye out on that 21 day EMA, keep an eye out on the volume also. One thing to take note of, generally your best time to buy is when the RSI is in the oversold territory. So when your RSI is below 30, anything over 70 is overbought, anything under 30 is oversold. So if you're looking to get into this stock, do keep an eye out on that RSI. You might be able to buy a good dip, but generally this stock is holding up well given the greater market conditions. So yeah, just to finish off, $1.03 is your first line of support. Second line of support is at 92/93 cents. First line of resistance is at $1.10, and the second resistance is at $1.17. However, with the 21 day EMA under the 50, 100 and 200 day moving averages, I would take the $1.10 and $1.17 price points very lightly. I'm looking for this 21 day EMA to go back over the 50, 100 and 200 day moving averages. So if you appreciate that, if you appreciate the update, the chart analysis that I keep doing, do subscribe to the channel so I can keep bringing you more content. Hit that like button, it does support the channel and supports the video. It's all to do with YouTube's algorithm, and I will see you on the next one.